What actually happens when you try to trade stocks with just $10? If you've been scrolling through short-form videos lately, you've probably seen the promise: turn pocket change into serious wealth with the right strategy. But here's the truth nobody likes to say out loud. $10 won't make you rich overnight. What it will do, though, is teach you exactly how markets work, how your own psychology reacts to price swings, and why the real edge in investing isn't about timing the market. It's about building a system. I'm V. Naiman, and this is Wealth Forge. Today, I'm walking you through a real controlled experiment where I put exactly $10 to work in the equity markets. I tracked everything, measured the results, and pulled out the practical lessons every new investor needs to know before they ever hit the buy button. Let's start with the setup. I opened a standard retail brokerage account that offers fractional shares and charges 0 commissions. I split the $10 evenly. $5 went into a broad market S&P 500 index fund, and $5 went into a single large cap technology company. I chose this split deliberately. It lets us compare two completely different realities: owning a slice of the entire market versus betting on one company's earnings, management, and competitive position. I set the clock for 6 months. During that time, I didn't add money, I didn't trade, and I didn't refresh the app every time the market dipped. All returns were calculated on a total return basis, meaning any dividends that came through were automatically reinvested into fractional shares. And just to be clear upfront, this isn't a recommendation to copy my trades. It's a transparent look at how microcapital behaves under real market conditions, using standard brokerage mechanics and historical price action as our baseline. So, what actually happened? Over the 6-month window, the index fund portion returned roughly 8.4%, while the single stock came in around 12.1%. On a $10 account, that's about 42 cents and 60 cents in absolute gains. Now, I know what you're thinking. That's barely enough to buy a coffee, and you're absolutely right. But here's what matters. The percentage return is exactly the same, whether you're working with $10, $10,000, or $100,000. The math doesn't change with your account size. What does change is your behavior. That single stock position swung nearly twice as much on a daily basis as the index fund. There were days it dropped over 4% in a single session. When you're trading with tiny amounts, those swings don't hurt your wallet, but they absolutely train your nervous system. And that training is where most retail investors lose long before they ever run out of money. You either panic sell at the bottom or you chase green days at the top. Both are expensive habits. Behavioral finance research consistently shows that emotional decision-making is the single largest drag on long-term portfolio returns. And starting small is the safest way to learn how to sit through volatility without reacting. We also can't ignore the invisible costs. Even in a zero-commission world, you're still paying the bid-ask spread on fractional fills. Your order routing might be subject to payment for order flow mechanics, which is fully legal and increasingly transparent thanks to recent SEC rule updates. But it still means your execution price isn't always the exact midpoint you see on your screen. And when dividends reinvest, they're taxable events in a standard brokerage account, which quietly compounds over time. None of this means you shouldn't invest with small amounts. It just means you need to understand the mechanics before you expect the machine to work for you. Now, let's zoom out for a second, because this experiment doesn't exist in a vacuum. The macro environment right now is fundamentally different from the easy money era of the early 2020s. Interest rates have normalized from their historic lows. Inflation has cooled but remains structurally sticky in services and housing. And equity markets are heavily concentrated. The top 10 companies in the S&P 500 have driven a massive share of total index returns over the past few years. That's not a prediction. It's a structural reality you have to account for. At the same time, retail participation has exploded. Millions of new accounts opened with under $5,000 in starting capital. Fractional shares made that possible, and that's a good thing. But access doesn't equal advantage. The data consistently shows that long-term wealth creation still comes down to three things: consistent capital deployment, diversified exposure, and the discipline to stay invested through full market cycles. You don't need perfect timing. You need a repeatable process. So, what do you actually do with this? First, treat your first $10 as tuition, not a lottery ticket. Use it to learn how to place orders, read a ticker, understand bid-ask spreads, and sit through volatility without reacting. Second, switch to a dollar-cost averaging mindset. Set up automatic deposits, no matter how small, into low-cost, broadly diversified index funds. Time in the market mathematically reduces the risk of buying at a peak, and over rolling 5 and 10-year periods, it consistently outperforms tactical stock picking for the vast majority of investors. Third, protect your downside. Do not use margin. Do not touch options or leveraged ETFs in a micro account. Your goal right now is capital preservation and behavioral training, not amplification. Fourth, track your allocation, not just your balance. A simple spreadsheet logging your contributions, percentage returns, and emotional reactions to drawdowns will compound your financial literacy faster than any single trade ever will. And finally, scale intentionally. As your account grows past a few $1,000s, introduce fixed income, consider international exposure, and move your core holdings into tax-advantaged accounts like an IRA or a 401k if you have access to one. The goal isn't to turn $10 into a fortune. It's to build a system that survives recessions, bull markets, and your own human instincts. Before we wrap up, I need to say this clearly because it matters. This video is strictly for educational purposes. It is not financial, tax, or investment advice. The returns discussed are illustrative, based on historical market behavior and standard fractional share mechanics, and they will vary depending on your exact entry point, broker execution, and tax situation. All equity investments carry the risk of principal loss, and past performance is never a guarantee of future results. If you're making decisions with real money, please consult a licensed financial professional who understands your full financial picture. If this breakdown gave you a clearer, more realistic view of how markets actually work, I'd appreciate it if you subscribed to Wealth Forge. We're building a channel focused on straightforward, data-backed personal finance and investing guides. No hype, no get-rich-quick promises, just the mechanics of building wealth responsibly. In our next video, we'll walk through exactly how to structure a 3-fund portfolio on a $50 a month budget, and why asset allocation consistently beats stock selection over full market cycles. Until then, invest with discipline, protect your downside, and remember, the best portfolio is the one you can stick with. Thanks for watching, and I'll see you in the next one.